It's a great observation about hotels being both real estate and operations. And there's a popular saying that hotels are real estate twice during an investment period. Well, on the day you buy it, on the day you sell it. And everything in between is an operating business. I wouldn't have it any other way. I once thought I should get some more experience outside of the hotel space and started working on office and multifamily, and I was just bored. But hotels are exciting. It's exciting because it is an operating business. You can look at the real estate and understand its location and analyze the market in which it operates and its competitive set and figure, wow, this is a great real estate investment. But if you screw up the operations, that great real estate investment is now losing money possibly at the operating level. It's no longer a great real estate investment. You've got to work the operations just as hard during your ownership period as you might imagine. And so how are we successful at both the real estate and the operations? It's really having a great team of people. Teams that understand real estate fundamentals and people that understand how to operate hotels and restaurants. When you can marry the two of those, then you really have something special in the investment class. From a real estate perspective, you really have to consider what's happened over the last 3 cycles in terms of declines in RevPAR. And if you look at the depth of drop in RevPAR, revenue per available room, you'll see that over the last 3 declines, cyclical declines, it's actually gotten deeper and deeper and deeper. And why is that? Why are things dropping so quickly? Is it circumstantial? Perhaps. But what I think is happening is that the internet and the ability for people to buy their rooms on a literally last minute notice, and for operators to change the pricing on a last minute notice, has introduced a lot more volatility to the class and to selling of rooms. And if you figure there's some 50,000 general managers out there in Hotel Land USA that are desperate to meet their budget. And if there is some downturn in their economy, if the market starts turning down, what are they going to do? Unfortunately, they drop prices to try to rebuild occupancy. And now in this internet space where there are these to-the-minute price changes, once a general manager changes their pricing on their hotel, a competitor will drop to meet that. And so it's a race to the bottom, unfortunately. And so I think what's happened is that's caused the floor to lose its stickiness. And so rates drop so fast and so far. And of course, it's much, much harder to rebuild rate than it is to lose rate. So it's added an element of risk to the industry that an operator really has to, and an investor really has to understand. How to stay ahead of it? It's a very interesting question. It takes a lot of data collection and data analysis. And that information actually is available in a much more transparent way today than it ever was before. And we've spent years building a proprietary revenue management program that doesn't just look at history, but it crawls around the web and looks at the future. What's happening with airlines? What's happening with our competitors? Where are they pricing their rooms for that particular date in the future? And are they booking business? And so we get a real sense for whether the market is strengthening or weakening in the future. And that in turn tells us whether we want to build occupancy today or hold back inventory and reprice it at a higher rate closer in. Perhaps other hotels have gone ahead and scooped up occupancy too early, and now we're the ones left with the only available rooms in the market. Well, that gives us a pricing advantage. Likewise, if it's not a strong day into the future, we want to build early at a higher rate so that when everybody else is dumping their rooms, then we've already taken business at a higher rate. There's another element right now that's changing the landscape, and that is the shared economy of rooms. Companies like Airbnb, if you're sitting in your apartment and you know the Super Bowl is coming to town, and you're not going to attend the Super Bowl, in fact, you may want to take a trip to Hawaii or something and get out of town, why not put your room, your apartment on Airbnb and accommodate visitors that are coming into town. And so in those compression nights, where the hotel inventory used to be static, you only have a certain number of rooms regardless of how busy that particular night is. Now inventory fluctuates pretty wildly, and it grows to accommodate busier nights. And so that's caused some loss in pricing power during certain nights for hotels. And so again, you've got to be cognizant of not only your hotel competitors, but Billy Bob and Mary Jane that are putting their house on the market during a busy night. And watch those kinds of sites like Airbnb. Where are they pricing? Are they is there an increase in units coming onto the market in that particular night? So that you can adjust your pricing and really determine, when do I grab that occupancy, when do I hold back, and wait for the market to come to me. It's a much more intensive traders market today than it ever was before. Oh, it absolutely matters. And I think just as an overlay comment, as a macro comment, I think I understand the need for these mergers to happen, and that there is value into the big getting bigger. And the hotel industry is actually very small, really. When we're inside of the industry, we think it's very big. But when you look at the competitors and the players, and you compare them to other non-traditional companies that are in our space, and by non-traditional I mean particularly those that use the internet as a portal, like Expedia or Hotels.com or Airbnb, and use other inventory that they don't own but market it through their portals. These are businesses that are investing billions and billions of dollars in marketing to move the customer from the traditional hotel businesses like Marriott and Starwood and Hyatt and Hilton over to their platform. And let's build loyalty with Airbnb. Let's build loyalty with Expedia, and try to move them away. So the customer is understandably a little confused about branding now. Is it Marriott? Is it Expedia? Am I loyal to Airbnb? Where do I line my loyalties to? Well, they divide it up. They actually become loyal to all those brands. And so when you're a hotel company that has a relatively limited amount of money to spend on marketing compared to these companies that are in the business of building market share, they don't care about profit right now. They want to build market share, so they will invest billions of dollars. Their ability to capture the eyeballs and loyalty of customers dwarfs the money that's being spent by Marriott or Starwood as individual companies. So together, they will be stronger because they'll have more money available to them, a deeper base of customers in which to build upon and compete against these other intermediaries. So from a macro standpoint, I understand the need to merge and the need for the big to get bigger. I think bringing it down to one versus the other, I really didn't have a dog in the fight, so to speak. I didn't know much about Anbang, so I couldn't really analyze them as a comparative way to Marriott. But I've known Marriott for very long. We have Marriott hotels as well in our portfolio, and very much respect what they do. I think the challenge ultimately will be in merging two different cultures, and hopefully, and I know that people are very smart at each of those companies, they will pull the best practices from each company and make a stronger single company. But mergers are difficult. It will be a challenge, and I respect all those that hang in there for that fight, so to speak, and that struggle to emerge as something stronger and better as one than two separate companies. I think what's great about Cornell hotel students, students that are studying here now and students that have graduated and will always carry that place in their heart and mind, that experience with them. I think there's a lot that is consistent across the group. But one thing that really stands out is their passion for the business. There's not much that will trump passion. And passion will really get you far as an individual and as a team player within our company, for sure. And real estate investing, we're investing our own personal money. Every employee that works with us is investing their own money, if they so choose, in the properties we buy. You better be damn passionate about what you're doing and really believe in what you're doing and work hard to make sure that the decisions you're making and the assessments you're making are correct. And so it takes a lot of passion. So I'd start with there. That's really what I think sets a Cornell hotelier apart from most others. I think the quality of the education is very, very high, very strong. I think one of the things that rings very true for us in our world is the ability to communicate and present yourselves, to form ideas and to present those ideas in a way that can be understood and in a way that your passion comes through in your conviction to those ideas. That, again, is a talent that is nurtured here at Cornell that we value a lot. And then I'd say the third thing is really the strive for innovation. Let's keep pushing the envelope. Let's keep finding ways to be better at what we're doing and continue to be the best. That takes work. It doesn't just happen, obviously. And so those are the qualities that we value a lot. Ultimately, people do business with people they like and they want to do business with. And I think the alumni network at Cornell is very strong, and it keeps people together, working together and collaborating even beyond the boundaries of our company. And that really comes back to help not only us as a company, but our teammates as well, to see them grow and nurture on the back, so to speak, of everybody else in the Cornell alumni network that's helping to further each other's careers in this field. It's really a special asset. I would say, probably one strong piece of advice is don't get greedy. Real estate is, I think a lot of people get into real estate with the idea of making money, and that makes sense. A lot of people can make a lot of money off of a single real estate investment, which is what's so special about this. There's not many investment classes that you can describe that way. And it's a cyclical business, though. And if you hang on for too long, and if you don't have the wherewithal to hang on too long, it will come back and whipsaw you in a way that you're not going to be happy. It's not going to end well for you. So I'd say don't get greedy. Enjoy the journey. That's really what, when you are successful and looking back over the last 30 years of your career, you're not going to think so much about that bonus you made or the paycheck you got or the returns you achieved on a particular deal. You're going to think about the people you worked with, the environment that you were working in, and the assets that you had an impact on. So remember the journey. And enjoy it, enjoy the moment. That's really my key advice. In terms of what do I look for when we're looking to make a real estate investment, there's a lot that I could describe. But one thing we really look for in our, how we differentiate ourselves is to really be turnaround specialists. And so we look for distress. We want to see, because that operating business and that real estate are two different things to consider. You could look at location and say, well, this location is getting better. Okay, well, let's invest in the location. We could say, well, that location is great, but the property isn't producing cash flow. Why isn't it? Well, the operating business is all screwed up. So we look for that kind of distress, either management distress or physical distress, or the property is just mispositioned in the marketplace. Maybe the market has gotten better and the hotel operation has not gotten better. And so it's losing it's not accessing all of its potential. So really looking for distress is a key element of what we search for. And then we can get to work. We can renovate the property, we can improve the management, we can change the brand, we can run it as an independent, we can reposition the property. If we weren't putting ourselves to work, we might as well just buy shares of a real estate investment trust. So distress is a real key element. We also look for a growing market. We're not trying to time the market. That's a wild guess, and usually you're wrong, or we're wrong. So the key is to not try to time the market, buy in a rising market where you can really take something that's distressed, improve it, and ride the tide of the market. And that's really how you achieve above market returns.